out, right? I think that makes sense. The labor market, jobs report, I'm sure you guys have been talking about this all day, right? In our view, this is a cooling. This isn't a labor market that's really stalling out. I don't think much has fundamentally changed since the beginning of August. So that's important to note, right? It's just been a little bit of positioning. Just what I'm seeing in semiconductors is the example, and tech's really selling off, taking it on the chin.
Is this what the Fed wants to see? I'm not talking about the market reaction, because we're told the Fed has a dual mandate, and then that mandate doesn't include the equity market. But is this what the Fed wants to see when it comes to the labor market?
I think so, and I think this gives them more reason to cut by 25 basis points. That is our base case. I know those odds have been oscillating today between 25 and 50, but again, we're in that 25 basis point camp. I think the inflation print that's going to come out on the 18th, it's not time to call the all clear, I actually think, on inflation. And it was only 2 months ago when we got an inflation print that actually triggered a massive rotation in markets.
Yeah, we're actually set to get CPI next week on the 11th. And that's set, according to economists surveyed by Bloomberg, 32 of them, 2.6% is what we, and again, it's not the preferred measure of inflation, Emily, but that's 2.6 is getting closer to 2.
Yeah, I mean, I'm wondering, when you think about the August that we had, there was some fear that sell-off was the beginning of a broader unwinding in markets. Do you agree with that framing, especially now that we're getting this data that the Fed kind of likes and kind of is pointing to more of a soft landing?
Right. I think all that data actually probably bolsters the case for a soft landing. We saw basically at the beginning, right, some chop around some mechanical yen carry trade for sure. It was a growth scare at best. And then I think we got a revised Q2 GDP report that told you actually the consumer was in better shape than initially thought. And a GDP for Q2 at 3%, that's very healthy. The Atlanta Fed GDP for Q3 now is saying 2%. I mean, again, this is a moderation in growth, but this is by no means a recession. And we think the Fed is embarking on a non-recessionary cutting cycle.
So, non-recessionary cutting cycle. You don't think we're in a recession or headed to a recession?
No, and I don't think that there's a lot of data out there to sort of suggest that, right? Particularly data that's leading and not lagging, like we saw today with the jobs market.
So then, where are you finding opportunities in this market?
So unfortunately, this takes a little extra legroom here, but I do think you have to look under the index, under sectors, right? It's tough to make broad sector calls in this environment. Like, for example, industrials would not be a sector right now that I would be recommending or overweighting, but I still like the aerospace and defense industry, right? And I think there's a lot of legs there. So unfortunately, this is about quality. This is about earnings growers. In Q2, we saw, for earnings, we saw 5 out of 11 sectors growing their earnings by double digits. I mean, that's earnings, that's broadening. So I'm tracking earnings into Q3 to see sort of where we see opportunity.
Have clients been calling this week with the sell-off?
Yes, and then they tell you how much they have in cash, because it's almost like a I told you so moment a little bit, right? I mean, there's a lot of uncertainty out there, and that's what I'm hearing from clients.
So they do have a lot of cash, and they're ready to jump on opportunities when they see the time is right. Do they feel like things are still too high right now?
Unfortunately, there are a lot of clients that think there's more to come on this like downside pullback, just given the confluence of issues that we have ahead of us, right?
Do you think there's more downside to come?
I think, we could definitely see more to this pullback. I mean, there's still the election cycle in front of us. We have a debate next week. And again, CPI, who knows what that's sort of going to bring. So, yeah, I do think that there could be more to this pullback.
Do you do anything particular in portfolios to prepare for the election? Because I think it was yesterday we were talking to Abigail Doolittle, who was pointing out that when you look at the VIX futures curve, which is getting into a little wonky territory, but it looked like traders were not really bracing for a lot of volatility around the election. And so that could be seen as maybe an underappreciated risk.
I mean, maybe we're pulling forward some of that uncertainty too. This has been an unusual election cycle, but when it comes to portfolios, I mean, we're thinking about corporate profits, so sort of that underlying strength. And that's really the North Star. Policies, we're not going to start positioning portfolios sort of around where we think candidates are going, but we are thinking about gridlock or not. and the polling's just getting tighter, particularly in the swing states.
Gridlock or not is more important to you than who's in the White House?
Yeah, just in terms of what the market's looking for. I think the market would be more nervous about like a Republican or Democratic sweep.